Ever noticed your stop-loss triggers mere pips before the market reverses in your favor? This isn't coincidence, it's design. Large operators systematically accumulate retail stop orders clustered at obvious technical levels. They engineer false breakouts to trigger your exits, absorbing your positions at favorable prices before the real move begins. Understanding this composite operator behavior transforms stops from liabilities into strategic advantages. For example, watch a support level at 50 holding multiple tests. Retail traders predictably place stops at 49.95. Professional money drives price to 49.90, triggering the cascade, then immediately reverses to 5200. The shakeout completes, weak hands exit, and the true markup phase commences with reduced selling pressure. Let me explain something fundamental that most traders never grasp: the composite operator, that is, the combined force of large banking interests, professionals, and dominant market forces, cannot simply buy or sell whenever they please without consequence. This is the critical distinction between the public trader and the professional. When you wish to purchase 100 shares, you enter your order, and the transaction completes almost instantaneously with negligible impact on price. But consider the predicament of the operator who must accumulate 50,000 shares, or perhaps 500,000. If he enters the market aggressively, displaying his intentions, what occurs? Price moves against him immediately. Each successive purchase lifts the offering price higher. He finds himself chasing the market, paying progressively more for each lot, and alerting every speculator to his campaign. This is intolerable to the professional mind. Therefore, the operator must employ subtlety and method. He requires sellers, a continuous stream of willing sellers, to absorb his buying without disturbing the price equilibrium. But where does he find this necessary supply, particularly after a decline when most holders have already sold, when the weak hands have been shaken out, and when the remaining holders are determined to wait for higher prices? This is where your stop-loss orders become invaluable to him. You see, the public congregates their protective stops at entirely predictable locations. Study any chart, and you will observe the obvious levels, just beneath the last prominent low, just above the previous high, at round numbers, at yesterday's extremes. These clusters represent concentrated liquidity, guaranteed sellers below the market and guaranteed buyers above it. The operator, through his network of commission houses and his observation of the tape, knows approximately where these stops are lodged. It is not guesswork, it is intelligence gathered through systematic observation of order flow and volume characteristics. When he requires supply during accumulation, he deliberately depresses price to the level where stops are triggered. The cascade begins, stops hit the market as sell orders, and he absorbs them eagerly at depressed prices. The public sees breakdown, he sees opportunity. Similarly, during distribution, when he must unload his line to the public, he marks price up to trigger buy, stops above resistance. The public perceives breakout, he perceives exit. This is not manipulation in the sensational sense. It is simply the professional meeting his logistical requirement for counterparties. Your stops, predictably placed at obvious technical junctures, provide him the liquidity necessary to conduct his operations efficiently. He engineers price to these known levels, activates the supply or demand he requires, and then, only then, permits price to move in the direction of his true campaign. Understanding this dynamic transforms your entire approach to protective stop placement and position management. I have observed, over many years of studying the market's behavior, that the public possesses an almost infallible instinct for doing precisely the wrong thing at the wrong time. Nowhere is this tendency more evident than in their selection of stop-loss placement. The average speculator reads his books on technical analysis, studies his chart patterns with diligence, and then proceeds to place his protective stops at exactly the same locations as every other student of the same methods. He identifies a support level, perhaps a previous swing low that has held on 2 or 3 occasions. Aha, he thinks, if price breaks this level, the trend has reversed, and I must exit. So he places his stop 5 points below this obvious level, believing himself prudent and disciplined. But consider what has actually occurred. Thousands of traders, all studying identical charts, all reading identical books, all applying identical rules, have reached identical conclusions. Their stops cluster in a narrow band just beneath that visible support level, like sheep huddled together for protection. The composite operator need only glance at his tape, observe the volume characteristics at these levels, and he knows with near certainty where this ammunition is stored. Now, I must ask you to think as the operator thinks. If you possessed substantial capital and required shares for accumulation, would you buy them at the current market price, allowing price to rise against you? Or would you not rather engineer a brief decline to where you know, with reasonable certainty, that forced selling awaits you? The answer is self-evident. The professional identifies these obvious technical levels, your round numbers at 50, 100, 150, your swing lows and swing highs plainly visible on any chart, your trend lines drawn by every chartist, your moving averages published in every newspaper. These are not secrets. They are signposts advertising where the public has positioned itself. Then comes the execution. Price is marked down, perhaps 10 or 20 points beyond the obvious support. The stops trigger in sequence, first the most aggressive, then the slightly more conservative, then those who thought themselves clever by placing stops a bit further than the crowd. The tape shows sudden activity, increased volume, widening spreads. Panic selling emerges. The public sees confirmation of breakdown and expects further decline, but observe what happens next. Price finds support almost immediately. The decline halts abruptly. Within minutes, or perhaps within the hour, price has reversed and moved sharply higher, often surpassing the original support level. What occurred? The operator absorbed the supply created by your stops. He got his inventory at favorable prices. The stop hunt accomplished its purpose. The lesson is this: if a technical level is obvious to you, it is obvious to everyone. And if it is obvious to everyone, it is obvious to the operator. Therefore, it cannot be a safe location for your protective stop. You must learn to position your defenses where the operator has demonstrated true commitment through his actions, not where the textbooks suggest placement. Study the behavior at these levels, the volume, the spread, the character of the movement, and you will begin to perceive where safety actually resides. Now we arrive at what I consider the most valuable skill a trader can develop, the ability to read the tape and interpret what the volume and price spread are telling you about the true character of market movements. This is not mysticism or guesswork, it is scientific observation applied to market behavior. When a legitimate breakout occurs, when genuine buying or selling pressure enters the market with real conviction behind it, you will observe certain unmistakable characteristics. Volume expands progressively. The price spread widens as each successive bar or transaction covers more ground. There is persistence to the movement. It does not exhaust itself quickly. This is the signature of real supply meeting real demand, of authentic participation by interests of size who are committed to their position. But a stop hunt, here the tape tells an entirely different story, and you must train your eye to recognize the distinction. Picture, this scenario: price has been consolidating near a support level, showing relatively narrow ranges and moderate volume. Then suddenly, within a single bar or brief period, price plunges sharply below the support. The spread widens dramatically, perhaps the widest range you have seen in days. Volume spikes to levels far exceeding recent activity. Your immediate instinct, if you have not studied these matters properly, is to interpret this as the beginning of a significant decline. But watch what happens next, and watch it carefully. Almost immediately, Within the same period or the very next, price reverses. The decline halts as abruptly as it began. Price closes near the high of that widespread bar, or perhaps even back above the original support level. The following bars show narrow ranges again. Volume diminishes quickly, returning to normal levels. What you have witnessed is absorption. The composite operator engineered price down to the stop cluster, triggered the cascade of sell orders, and absorbed every share offered to him. The widespread on high volume was not distribution, it was accumulation disguised as breakdown. The stops provided him exactly the supply he required, and once that supply was exhausted, he had no further reason to maintain the depressed price. Compare this carefully with genuine selling pressure. When real distribution occurs, the decline continues. Wide spreads persist over multiple bars. Volume remains elevated as the operator feeds stock to the public over time. Price does not snap back, it deteriorates gradually or plunges further. I cannot emphasize enough the importance of this distinction. The public sees only the price movement, the penetration of support, and reacts emotionally. The professional observes the relationship between price spread and volume, notes the rapidity of the reversal, recognizes the absorption pattern, and understands the true nature of what has transpired. You must develop this faculty. Study your charts not merely for price patterns, but for the volume characteristics accompanying those patterns. Ask yourself, is this movement showing sustained pressure or brief manipulation? Is volume expanding progressively or spiking briefly? Does price continue in the direction of the break or reverse immediately? The tape will answer these questions if you learn to read its language properly. There exists a rhythmic quality to the operator's work that, once recognized, becomes as predictable as the tides. The professional does not act haphazardly or impulsively. He operates according to principles of efficiency and opportunity, which means he selects his moments with great care. Observe when these stop hunts most frequently occur, and you will notice they cluster during periods of thin participation. The early Asian session, when American and European traders sleep. The lunch hour in New York, when the street quiets and traders step away from their desks. Sunday evening openings, when the market reopens with minimal depth, holiday, shortened sessions. These are not coincidences. Why does the operator prefer these periods? The answer relates directly to capital efficiency. During active trading hours, when the market teems with participants, moving price requires substantial capital. There exists natural resistance, buyers appear at support, sellers emerge at resistance. But during these quiet periods, liquidity thins dramatically. The order book becomes sparse. A relatively modest amount of capital can drive price through levels that would require 10 times the resources during normal hours. I have seen instances where a few thousand shares, strategically placed during the Asian overnight session, pushed price through support and triggered stops that would have required 50,000 shares to activate during the regular New York session. The operator achieves his objective at a fraction of the cost. This is simple economics applied to market operations, but there is another pattern you must recognize, one that demonstrates the operator's psychological sophistication. He rarely strikes immediately at an obvious level. Instead, he employs what I call conditioning, a process of testing and re-testing that builds false confidence in the public. Watch how this unfolds. Price approaches a support level and holds. The public observes this and gains confidence. The support is strong. They conclude. Price pulls back, then returns to test the support again. It holds once more. Confidence builds further. Perhaps a third test occurs, and again the level proves reliable. By now, the public has complete faith in this support. They add to positions. They tighten stops just beneath the level, believing it impregnable. This is precisely what the operator desires. He has conditioned you to trust the level, to commit capital based on that trust, and to position your stops in the obvious location. Then, and only then, when commitment is maximum and stops are densest, does he strike. The final violation occurs, stops trigger en masse, and he absorbs the cascade. The lesson here demands patience and skepticism. When you observe a level tested repeatedly, do not interpret this as strength. Recognize it as potential preparation for violation. When stop hunts occur during unusual hours, understand this is methodology, not accident. The operator works when conditions favor him and prepares the public's psychology through repetition before executing his campaign. Time and pattern are weapons in his arsenal, and you must learn to recognize their employment. Having explained how the operator conducts his campaigns and why your stops at obvious levels serve his purposes, I must now address the practical question. Where, then, should the intelligent trader position his protective stops? The answer lies in understanding commitment. You must place your stops beyond the point where the operator has demonstrated, through his actions on the tape, that he is committed to his campaign, not where the textbooks indicate, not where the crowd congregates, but where the evidence of professional activity becomes unmistakable. Let me illustrate with a concrete example. Suppose a stock has been declining and reaches a support level near 45. Price tests this level and bounces, showing a wide downward spread on high volume, followed immediately by a sharp recovery. This is what I term a spring, a shakeout below support designed to trigger stops and test the remaining supply. If, after this spring, price holds and begins to advance on increasing volume and widening upward spreads, the operator has revealed his hand. He has completed his accumulation. The spring was his final effort to gather inventory at favorable prices. Now, where does the amateur place his stop? At 44.90, just below the obvious support at 45. Where should you place yours? Below the low of the spring itself, perhaps at 43.50 if the spring reached 44. Why? Because if price violates the spring low after demonstrating accumulation characteristics, the entire analysis is invalidated. The operator has not actually accumulated, or conditions have changed dramatically. Either way, you have no business remaining in the position. The same principle applies in reverse during distribution. When you observe an upthrust, price pushing above resistance on wide spread and high volume, only to close back below that resistance, the operator has shown his intention to distribute. Your stop, if positioned short, belongs above the high of that upthrust, not at the obvious resistance level where the public clusters theirs. This requires judgment, I grant you. You must interpret the quality of the movement, the volume characteristics, the nature of the test. A spring accompanied by minimal volume and narrow spread is not the same as one showing climactic characteristics. A half-hearted test differs from a decisive one. This is where your study of the tape becomes invaluable. I will tell you plainly. Stops placed using these principles will often be wider than the tight stops advocated by those who measure risk in simple point distances. You may be stopped less frequently, but when stopped, you will have received genuine evidence that your analysis was incorrect. You are not being stopped by the operator's maneuvering to gather inventory, but by actual market development contrary to your position. The professional trader thinks in terms of market structure and commitment, not arbitrary point measurements. He accepts that proper stop placement may require risking more points, but understands this is offset by far fewer false exits. Quality of signal trumps tightness of stop. Learn to identify where the operator has committed himself and position your defenses accordingly. This is the path to avoiding manipulation while maintaining necessary protection. Now you understand why your stops are hit with such regularity. It is not bad luck. It is not the market conspiring against you personally. It is simply the natural consequence of positioning yourself exactly where the composite operator requires liquidity for his operations. The solution is not to abandon protective stops. That would be foolish and invite catastrophic loss. Rather, you must fundamentally transform your approach to market analysis and risk management. You must cease thinking like the public and begin thinking like the professional. This transformation demands several commitments from you. First, you must become a student of the tape. Price alone tells you nothing of value. You must study the relationship between price movement, volume, and spread. You must train your eye to distinguish between genuine buying pressure and manipulative shakeouts, between real distribution and false breakouts designed to trigger stops. Second, you must abandon your attachment to obvious technical levels as safe havens for stop placement. Round numbers, previous swing points, trend lines drawn by every chartist. These are advertisement boards announcing where the public has gathered. The operator reads these same charts. He knows where you are positioned. Therefore, these locations cannot provide protection. Third, you must develop patience and the ability to recognize the operator's patterns. Watch for stop hunts during thin trading periods. Observe how levels are tested repeatedly to build false confidence before the final violation. Note the volume and spread characteristics that distinguish absorption from genuine weakness, accumulation from authentic breakouts. Fourth, and most importantly, you must learn to identify commitment. Where has the operator shown, through climactic volume and decisive price behavior, that he has completed his campaign? The spring that holds, the upthrust that fails, the test after accumulation that shows no supply. These are your signposts. Your stops belong beyond these commitment zones, not at the crowd's gathering places. I recognize this approach requires more work than simply placing a stop 10 points below current price. It requires study, observation, and the development of judgment. But consider the alternative, continuing to provide liquidity to professional operators at precisely the moments most favorable to them and most damaging to you. The market will always have operators. They serve a necessary function in providing liquidity and absorbing imbalances between supply and demand. Your task is not to rail against their existence, but to understand their methods and position yourself accordingly. When you comprehend how they operate, where they require liquidity, and when they have committed to their campaigns, you transform from victim to informed participant. Stop hunts will continue. The composite operator will not change his methods simply because you have studied them. But you can change your response. You can stop placing your stops where he needs them. You can learn to read the signals of his commitment. You can position yourself to avoid his manipulations while maintaining necessary protection against genuine adverse moves. This is the essence of professional trading, understanding market structure, recognizing the operator's campaigns through tape reading, and positioning yourself in harmony with professional activity rather than in opposition to it. Master these principles, apply them with discipline and patience, and you will find that your stops are hit far less frequently. And when they are hit, it will be for legitimate reasons that warrant exit, not because you have once again provided liquidity at exactly the wrong moment. The knowledge is before you. The choice of what to do with it rests entirely in your hands.